So next ratio that we want to study now is called EV by EBITDA. Okay, extremely popular model, again used for relative valuation, and a model which gives you a lot of flexibility, generally which can be used on any of the stock, whether the earnings is positive, not positive, the company's got too much debt, less debt, this can be used. So let's first focus on what is enterprise value. Okay. Now before I show you the formula, we would just do some background behind this. So think of it this way now, that there is a company which has got some assets. Okay, the assets include land, building, plant and machinery, whatever, and they have certain amount of cash. Okay, so they have that excess amount of cash here. Plus on the liability side, what they have is equity and debt. Okay, this is the current balance sheet of the company. Meaning of enterprise value is market value of operating assets of the company. Market value of operating assets of the company. And operating assets means these ones. That what is the market value of these assets in the company. Now let's think that we are looking at some complex company, okay, some company which is into shipbuilding business. So now if you want to go and find out market value, it would have probably 200, 300 different assets. You'll have to find out market value of each one of them, which is going to be really difficult. So instead of doing that, use a different method. What you say is, I will go and find out market value of equity, plus I will find out market value of debt. Now market value of debt and generally book value of debt is same, generally, not always. So I'll take market value of equity plus market value of debt. So total of these two, can I say is equal to total of these two? Yes, minus cash. And what I have now is enterprise value of the company, which is nothing but market value of all the operating assets. Are we okay with this? So enterprise value is equal to market value of equity plus market value of debt minus cash and other investments. Short-term investment or any non-business related investment. Any questions you want to ask on this front? Market cap. So the EV keeps changing. No, EV keeps on changing. Price to earning ratio, price changes every minute. So we take the day on which I am valuing, उस time पे जो price है वो, same logic. So these like investment into securities and any other things will also be reduced. Anything that's non-business related, reduced. Okay. So now we have enterprise value. So let's say there are two companies. The value of operating assets for both the companies, let's assume 100 and 100. On my base of 100, I am being able to earn operating cash flow, and EBITDA includes only the operating cash flow, right? We are not reducing depreciation, so it's a cash flow number, and it's only related to my business. It's not including my interest income or other income. So this firm could generate 20, this firm could generate 40. Who's better? B. So now what we will do is, in this fashion, we will calculate EV by EBITDA ratio. Let's say of 5 firms, A, B, C, D, E. Then we will calculate an average of EV by EBITDA ratio of all those firms. Let us say that came out to be 5. Meaning of which is, in this industry, on an average, a firm which has got EBITDA of some X amount, the EV of that amount should be 5x. In this industry, on an average, a firm which has got EBITDA of X amount, the enterprise value of that company is 5x. And once you know enterprise value, so you know that enterprise value has to be 5x. Once you know enterprise value, then from enterprise value, you can reduce market value of debt, you can add back cash, and then what you have is value of equity. So what was the original formula? EV is equal to equity plus debt minus cash. Therefore, equity is equal to EV minus debt plus cash. So from enterprise value, reduce the market value of debt, add back cash, and then what you have is value of equity. Take value of equity, divide by number of shares, you've got your valuation per share. This is the model. Simple? Yes. Now what is the flexibility? Imagine a scenario where a company keeps on changing its debt structure. Sometime it takes too much of debt and reduces debt, so on and so forth. In that case, because of debt is changing so frequently, your earnings will keep on changing. Because interest amount will change, earning will change. But this model is robust. This model would not be affected by how much debt is being changed. This model would not affect because EBITDA comes before interest. Enterprise value includes equity plus debt both. Therefore, the model gives you a lot of flexibility to find out intrinsic value irrespective of how numbers are volatile or how numbers are changing. Are we clear here?